Welcome to the Profit Cash Growth Podcast. This is the podcast for 6 and 7 figure business owners who are looking to grow a financially successful business. My co-host Claire Hancock is a finance director, chartered accountant and entrepreneur. And every week I'll be exploring guidance and frameworks designed to help you increase your profits, improve your cash flow and grow your business. Hi Claire, how are you this week?
Good, thank you. Been very, very busy. The economy definitely seems to be on the up this week, and we've had a record-breaking week. So, yeah, it's a very positive start to February for us at the moment. How about you?
Good. Yes, the same. I would say, January just seemed to get better and better as we've entered February. Business is booming after 12 months of a difficult market, really. So really pleased to see that. I think confidence is driving that. General economic confidence means people can move forward and do things, make big purchases and all that kind of great stuff, which is good.
Yeah, definitely. I'm not seeing any of the downside that some of the economists are talking about, and there seems to be plenty of money swishing about at the moment. Certainly if you go to restaurants and bars on a Saturday night, you can see they're rammed all the time. So definitely looks like a positive for our economy at the moment.
Absolutely. As we always say, a good business will always float to the top. So anyway, shall we dive straight into this week's news story? So I believe this week you've seen something that's caught your eye in the news.
Yes, I've been reading a lot about Uber this week. They have been in the news because over the past 10 years, Uber hasn't made a profit. In fact, they've racked up nearly $32 billion in losses. And for the first time ever, they recorded 4 consecutive quarters of making a profit. So just to clarify, they have made a profit in a quarter previously, but they've never had 4 profitable quarters in a year. So this is a record for Uber.
So I always see this, and with all big businesses, obviously we know they're sort of hugely funded, but why do you think that they can go for so long without making a profit, and that runway is kind of, so big for the plane that takes off?
So obviously Uber floated, that's how they funded a lot of their business, but they have invested so much money into research and development of new product lines. When they first started out, they were just a taxi business, and now they're Uber Freight, they've got Uber Eats, all of these different brands of Uber springing up, especially with automation, driverless cars and things like that. But actually, one of the reasons that they've been able to go for so long is because the cost of debt has been so low, with interest rates at historical rock bottom rates. And that actually came back to bite Uber in the bum in 2022 when interest rates started going up. And it was very clear that this actually wasn't sustainable for Uber. They couldn't have low profits, huge investments and huge debts with the interest rate soaring. So their share price actually plummeted over 50% in 2022. And that was a very clear signal that investors were wanting profitable companies now, and that they weren't necessarily willing anymore to invest in these companies on a long-term basis if they could get easy returns of 5+% by putting the cash in the bank.
Yeah, this is why we're seeing these kind of so-called zombie companies, as they call them, that have been propped up by very, very cheap debt for long periods, but actually perhaps aren't fundamentally profitable as profitable as they need to be to sort of keep going on an ongoing basis. But
yeah, absolutely. And zombie companies is actually one of the things that Jeremy Hunt's been talking about quite a lot, saying that zombie companies are basically they're companies that barely get by, and they've been able to survive because they've been able to source debt really low to fund themselves. And Jeremy Hunt has been saying a lot that actually one of the reasons why we have low productivity in the UK is because of these so-called zombie companies sapping good workers and investment from banks and venture capitalists and things like that could, if these zombie companies didn't exist, this money and resource could go into other companies who are much better at turning that into a really good profit. So it's a really interesting conversation about how damaging the low interest rates have been to the UK business industry over the last 10 years or so.
Yeah, what did you think about the self-employed element with Uber, when the IR35, is it IR35, where they had to suddenly employ everybody, and I felt like that was going to have a massive impact on kind of the margins that they had there, but clearly they're coming out, with these big numbers.
Yeah, it happened a fairly convenient time for Uber, actually, because at the start, they had been incredibly aggressive on their pricing. And one of the reasons that they weren't making much of a profit is because they priced themselves far lower than competitors to win market share and grow their business. And they had established themselves as a very, very well-known brand. And, they got to that point, it's called genericized, I think, where you refer to a taxi as an Uber rather than a taxi. They'd got to that kind of that holy grail of like Hoover and Biro and Tannoy and companies like that.
When your business gets used as a verb.
Yeah. So actually, they were at the perfect point to increase their prices anyway, because, I will always default to Uber as the first app because of convenience. I don't want to sit on the phone and speak to taxi companies and things like that. So from that perspective, actually, it didn't have as much of an impact on the future of their business. Obviously, it did come with some quite chunky historical payments that they had to make in terms of fines and compensation to employees and things like that, though.
Great, brilliant. Fascinating stuff, Claire, as always. But let's move on to this week's sort of deep dive and see what we're going to chat about. So I've been watching one of your YouTube videos this week, which was titled The Safest Ways to Grow Your Business, but actually is four ways to grow your business, and they're not all necessarily safe, are they? And those were market penetration, market development, product development, and diversification. So shall we just dive straight in with number one?
Yeah, so I'll give you a little bit of an overview for anybody who hasn't seen the YouTube video yet. I talked about a very famous economics or business model called the ANSOF matrix, ANSOFF. So do go and Google it, check it out. It's very, very visual matrix, and it very clearly breaks down the 4 available strategies if you want to grow your business. Every growth idea that a business has would fall into one of these 4 strategies. And it's a really phenomenal way of putting some structure behind your ideas. But also what I think is most important about this is that it really just helps business owners to manage the risk when it comes to growing their business. And it's a really great way of helping to decide which is the right option to move forward with.
Fantastic. Brilliant. And that's all about, so in my world of a state agency, that would be about exactly what I'm pursuing at the moment, which is growing market share within a tight geographical area or something along those lines.
Yeah, absolutely. So the first and least riskiest option for growing your business is called market penetration. So that would always be your number one option as a business owner. And that is when you're going to simply do more of what you're doing now. So you're going to take your existing products and your existing customer base and you're going to sell more to them. So when I say customer base, sorry, I don't mean your actual customer list. I mean your type of customer or your marketplace that you're serving into. So if you're serving, I don't know, if you provide catering to schools, you're going to try and sell more catering to more schools. It's as simple as that. Yep. And that's called market penetration. So you either need to grow your market share, so you need to steal market share from your competitors, or if you're in a growing market, then this is also a really great way to grow. So as I said, this is the least riskiest because it's doing more of what you already do. So
what's realistic then in terms of sort of saturation or saturating the market? If I'm a business owner and I've got 5% of my market that I believe that I've got there, what is it feasible that I could double that to 10? Is it feasible that it could be 25%? Is there an easy way to understand how far you push that? Because presumably we're going to move on to when you've really focused down and reached some sort of saturation point, that you then move to scaling outside of that market or something along those lines. But how do you know when that time is?
Yeah, it is a really difficult question, and there isn't a right or wrong answer for that.
I would
say that you need to have a look at how big the overall market is.
Yep.
If the market isn't growing, then that is going to be quite difficult, because the only way for you to increase your income in this market is going to be by stealing market share. So then it all comes down to differentiation, how good you are at competing with your competitors. And it also depends whether you're in a hyper-local market, because if you're a hyper-local business, so that's something where you've got a physical geographical location, so maybe like a nursery or a hairdresser's, where people are only ever going to travel so far to you. If you're limited on geography in a hyperlocal business, then again, your market will only ever be so big, and there isn't much you can do about that. So it does depend on a lot of factors that go into the business. But what I would say is that most businesses can grow to multi 8 figures just on market penetration alone. And I think we've all heard of the sort of shiny object syndrome and focus and things like that. And I think that's the biggest mistake that a lot of small business owners make, is that they underestimate the opportunity in market penetration, and they come up with these amazing fancy ideas to take on one of the other growth strategies when they haven't yet exhausted market penetration.
That was going to be my next question. Do you come across that often with clients that you work with and businesses that you work with, that actually they're just spreading themselves too thinly and they're not really, milking every opportunity that's right under their nose before they move on to the next thing? Or I used to call it making sure that one plate's spinning before you then move on to spinning the next plate, because the ultimate thing is that they all need to spin at the same time and you don't want them to drop.
Yeah, absolutely. And when we're talking about big businesses should naturally be doing market penetration as sort of their day-to-day business. They've got very established sales teams, and their kind of sole job is really market penetration. And they just got to keep that sales number increasing and increasing year on year. But when you're in a small business, you don't quite have the hundreds of sales force in your team to do that. So it does come down to focus. And that's why I think there's often lots and lots of opportunity that business owners just sort of gloss over and don't quite see how valuable this could be. Because if it's doing more of what you're doing at the moment, your business is structured for it. So from that perspective, it's easy. It's the easiest option. I will never say it's easy, but it's the easiest option because your processes, your systems, your people, it's everything that they're used to at the moment.
If there's, I guess looking at your competitors' market share is a good way to know where you are on that roadmap. And, a crude method would be saying, if the market leader can have X percentage, then that must be achievable in some shape or form to sort of replicate that with your own business. But, it is an interesting one. I mean, what's your view if you're trying to do that? If you're a small business owner and you're trying to sort of grow your market share, but you're not getting the results that you're hoping for, or you're not achieving that growth, what would you sort of suggest to them to do next? And if they know that they haven't saturated their market because they've got competitors that are far bigger, I know it's a very big question. But, would you say have you worked through these things first? What sort of advice can we give them?
Yeah. So if you are struggling to grow your market share, but as you say, your competitors have done it, so therefore it is feasible, then you do need to take a hard look at yourself, because probably something isn't hitting the mark when it comes to your product offering or your marketing, or perhaps something in your sales funnel. So that is also where I would be saying to business owners, they tend to get to this point where they're struggling, and they stop and they think, it's the strategy. It's the wrong strategy. Let's do something different. But
there has to be.
It isn't the strategy.
Yeah, they've got to find. The reality is, the frustration is that if somebody else has got that market share, it's doable. So therefore, if you're not growing, there's a constraint in your business. And the fundamental thing that you need to do as the CEO of your business is to find that constraint and work out how you get over that. And I think it's not easy. It's difficult, and clearly, chatting to people like yourself can help people explore things that they don't see when they're knee deep in their business day in, day out.
Yeah. The reality is as well, I know, Simon, you own an estate agency and you're number 2 in your town. And I know that you want to be number 1 and you push and push and push for number 1. But there is also a point where the cost of competing to become number 1 actually means that this probably isn't the most profitable route now. So I think if you're towards the top, then that's probably a sign that unless you're in a growing market, if the overall market size is just staying still. So take you, for example, Simon, with your estate agency, there'll only ever be so many houses in your local town. So if you're already
that's not true, is it? Because
they are building at the rate of knots, aren't they?
Actually, the beauty is we're in a market that is a naturally and organically growing market. Chimney pots are appearing, our population's growing. So actually, I would dispute that and say that actually, that it's great if you've got a bit of a tailwind behind you as well, because you're in a growing market. I've worked in a market in newspapers 20 years ago, and that was shrinking by 25% every year. Now that is difficult to grow a business into. But yeah.
But obviously the market size is not increasing considerably, and therefore I would suggest that number 2 is probably your saturation point. And I would consider whether, from a profitability perspective, the cost of competing to become number 1, is that really worth it, or is that a sign that you are now ready to move on to one of the other strategies? That's
fair enough. Great. Well, let's move on. So I've totally saturated my market. I've now got 25% of my market. I think that's probably as saturated as I'm going to get. I'm going to move on to growth strategy number 2 that you outlined in your YouTube video, which is market development. So tell me a little bit about that.
Yeah, so market development is where you are going to take your existing products and services and sell them into new marketplaces. So the most obvious that we've just mentioned is with an estate agency. Market development would be a case of opening a new estate agency in a new town. So you would just increase the geography of the area that you cover. Or if you're already UK based, you might go and decide to open a branch somewhere in Europe, for example. But you can also, when we're talking about new markets, we're also talking about different demographics. So maybe you might be a holiday company, a holiday tour company, and you specialize in the over 65s, and you might decide to go into the under 18s market, for example, or something like that.
Right, yeah. Completely changing your target market and trying to build upon it. So, I mean, my fear would be, and I'm sure a lot of business owners will say the same thing, is how do I do that, or what are the blind spots I need to look for if I move and focus on another market, another area, to make sure that the profitability and stability of my existing profits in my business remain the same. I don't want to swap one for the other, because that would be bad business. What should I be thinking about?
Yeah, so definitely profitability is a key one here. So this is a second least riskiest option, because you're taking everything that you've already learned in your current business and you're going to replicate it. But generally, I would suggest to business owners that they're only looking at replicating sales and operations if it's essential. And anything that's deemed, I said back office, so, finance, HR, IT, all of these kind of unsexy support services that sit in the background, even marketing to a certain extent, that you should be looking to leverage that across your multiple locations or multiple areas as much as possible. And that's where you really start to increase your profit, when you start to talk about scaling your business instead of growing your business. So scaling would be where you look to increase your business size and not increase your cost base. So if you're talking about an estate agency, Simon, you would go and put a sales team in, but you would probably have one person doing all of the marketing for both businesses.
Yeah, or one sales progressor progressing all of the cases across multiple branches and various things. So try and merge the back offices and get economies of scale from those type of things. Great, brilliant. So number 3, we're really getting a bit more risky here, as I understand, is product development. So again, what's product development, and when's the right time to do that? Should you do it at all, and what type of business?
Yeah, so product development has come sort of 3 out of 4 in terms of the risk factor on the Ansoff matrix. So it's definitely an advanced growth strategy. And product development lends itself to businesses best that perhaps struggle with sales and marketing, because what we're saying is that you are going to take your existing customer or your existing marketplace, but introduce new products to them. So we're not talking about new ranges. So if you're an ice cream shop, you're not just going to increase your flavors. We're talking about selling a completely new, different product line. Right, so that's why it's risky, because if you're thinking about stocked businesses, you don't really know whether these products are going to sell. You could end up with, you've got to put a lot of money into buying the stock, and you could end up with obsolete stock. And there's just everything about this is new, and that's why it comes with more risk.
How close is this to literally starting a brand new business? So are you leveraging existing brands or things like that? Are you literally starting from scratch? What does that look like?
You're not starting from scratch, because it's your existing markets, and that's where you've got a leg up on maybe a competitor that was starting from scratch. Because what you want to try and do here is you want to increase your customer lifetime value. And if you get this right and you do this in the most perfect way, then actually you want to increase your customer order spend. So if, for example, you own a soft play and you've got customers coming into your soft play, you don't just want to say, you can come into my soft play, or you can come into my outdoor play area, because that's an or. So all you're doing is splitting the customer spend. You want to say, come into my soft play and go outside afterwards for half an hour and buy some food from me. Come and have some lunch with me as well.
So this is kind of, if somebody, the whole soft play analogy that you're using is, I've got the soft play, now I'm going to have the cafe in the soft play.
Absolutely,
in addition,
yeah.
So that I've got another business that folds into the existing empire that I've got.
Yeah. And so this works really well when you think about like supply chain and buying up or down your supply chain. So, maybe if you're manufacturing something and you're buying a lot of boxes, then, you might look to move up or down the supply chain and buy one of your suppliers potentially, or buy one of your customers maybe. That's where you see this most often.
That type of thing. So quite an advanced strategy where once you've got some cash or you want to take your sort of big step change in your business through investment and various other things, this could be a really good way to do that.
Yeah. And in terms of profitability, this can be incredibly profitable, because if you take the analogy of a soft play like we just did, actually your marketing spend is about getting the customer through the door. So you don't have to market to them to come through the door for the soft play and then come through the door for the cafe. You just need to get them into your premises in the first place. So all of a sudden there's these economies of scale here as well. So if you do struggle with marketing, or your customer acquisition cost is high, so if you have a very long lead time, or you have a very high ticket price, then also this can be a really fantastic way to look at growing your business, because you've got such a high outlay to acquire your customer that you then want to try and milk every last penny that you can get out of them when they do become your customer.
Excellent. Brilliant. Great. And then number 4, finally, is diversification. What do we mean by diversification, Claire?
Yeah, so diversification is 4 out of 4 in terms of risk factor when it comes to a growth strategy. And what we are saying with diversification is that you are going to take completely new products and services and sell them to completely new customers or marketplaces. So you can see immediately why this is so risky, because you've got nothing you can leverage really. You've got no experience about your customers. You don't have an existing customer base that you can sell to, and you don't have any experience with these products either. So typically when you look at diversification, the most successful diversifications usually happen via acquisition, where you're buying another company because they come ready-made with all of the skills, all of the processes and all of the experience needed. So that's generally why diversification is normally best done through acquisition.
Okay, great. And kind of the big diversification names that sort of spring to mind for me are people like Blockbuster and the whole Blockbuster Netflix thing, the whole Jessup's, digital camera thing. These are kind of big businesses who, zooming out critically, should have diversified way earlier than they did, and it was the demise of them in many cases. But again, I guess it's really difficult when you're a very profitable business to say, like, do I do that? And what are the warning signs you're looking for as a business owner to say, I need to pull this number 4 lever, which is the high risk lever, because I really need to do this to continue to survive or move forward? Yeah.
So really, the best businesses when it comes to diversification are big companies that have got cash sloshing around. There is a phrase that when you have spare cash in your bank, there's a phrase that is buy or be bought. So it basically means that you use that cash and you buy another business, or someone will want to buy you because you're cash rich. So that's why this tends to be for the big corporates. Actually, Blockbuster is a really good example of where they didn't need to diversify. They actually just needed to do some product development, because they had a really, really good customer base. They literally had millions of customers that would go into their shops and buy from them. And there was a complete gap in the market that Love Film moved into, and started doing film rental digitally. So Blockbuster could have done that as well if they had actually done product development. They didn't need to diversify.
Diversify specifically. Actually, yeah, if you enact these various growth strategies at the right time in your business's sort of evolution, actually you can in many ways avoid that demise right at the end. So it's about doing the right things and investing at the right time and pulling the right levers. All very easy to say when you're on the outside of a business, all very difficult when you're knee deep in it day to day. And it's why, you need to take time out of your business to really think about it and make sure you're always working, on the business and not knee deep in it, which is the issue that a lot of people we come across have, really. So amazing.
I think it's very unlikely that a small business will need to diversify. because
the market will be big enough for them to just keep going
yeah.
and keep going, and then they can go overseas, and then, like, it's just
yeah, absolutely. The need for diversification comes when you are in a dying market and your products are at the end of their life cycle too. So some trends and technologies changes. There's something like videos where there's just no customer base for them anymore.
Sure.
If that is you, then you need to diversify. But the 99.9% of small businesses don't need to diversify. What you do get is you get people like me and you who just like buying businesses. And so that's where small business owners will just go and buy a business because that is what they want to do and that's what they enjoy. I think the need for diversification isn't there. It's more of I don't want to call it a hobby, but it is more of a passion than a need.
An acquisition. Yeah. There's almost another business there for that in its own right.
Yeah.
Brilliant. Well, thanks very much for taking me through those 4 ways to grow your business. And do check out the YouTube video if you've not on Profit Cash Growth. Really interesting. Again, Claire with her flip chart just brings it all to life for you. So I found that all very interesting. But anyway, let's move on to Profit Cash Growth Extra. So every week we're going to bring you a tool, a tip, a cheat sheet, a blueprint, whatever it is that we've come across that we think will help you with your business. Obviously, we come across tons and tons of things in the work that we do with lots and lots and lots of business owners. So this week, Claire, you've got something for us that you found really useful, a little bit of a hack.
Yes, so I have been using a piece of software called Opus. I hope that I am saying that correctly. OPUS. OPUS.
Yeah. Sounds like an oil company.
It does. It does create some fine art, let's say. So This is a fantastic tool because it's no secret that I have been trying to create more content just like this. So it's the reason that we started the podcast. I've also got my YouTube channel and we're posting a lot more on social media too, just to try and provide as much value as possible to our lovely audience. Anyway, Opus, I can simply put the URL or the web link for my YouTube videos into it and it will create up to 15 different shorts for me that can then be posted automatically onto social media. So I'm finding that is a fantastic tool for really taking your long form content and getting multiple pieces of short form content out of it. And it is cheap as chips as well. I think it's like $9 or something like that for a month. It's even got a free version on it. So it's a fantastic piece of software.
I've got a feeling that a lot of these tips every week are going to be very AI driven. I've got tons that I use in my business. You've got tons in your business. And also I think, I'm sure we're going to cover it over the weeks, but again, just the cost savings that's given you from using a physical editor and, this fear of what AI will potentially do to the creative industry by, being able to literally do it for you without, faster, cheaper, it's incredible.
Yeah, absolutely. I mean, I was paying £25 per short before and I was releasing about 15 to 20 of them per month. So so go from that expense to literally $9 and about in total an hour of time to just watch them and make sure that they're viewable and things like that. It really is fantastic. So yeah, AI is definitely taking the creative world by storm.
So that's Opus, OPUS, for video editing tools for your shorts and various other things. Brill. Thanks, Claire.
Thanks, Simon.
So thanks for joining us again this week, and you'll hear from us again next week. I think next week we're covering cash or out, which is how to exit your business, whether you want out of your business, whether you want cash from your business. We're going to deep dive into that topic, which I think is going to be a fascinating one, probably will resonate with a lot of our listeners. And where can people find you and your business, Claire, and what's the best things to do if they want to chat with you, work with you?
So Profit Cash Growth is the business name. We are on obviously the website and we are on all the social media platforms, Facebook, Twitter, Instagram, X as it's now known, TikTok, YouTube, absolutely everywhere. Hopefully you will see my efforts to increase my visibility have been paying off and you should find it quite easy to find me. Indeed, definitely get yourself on the YouTube channel. That is one of the best places and some of the most valuable content, of course, after this podcast. Thanks, guys. See you next week. Bye.